Welcome to Taking Stock for the week ending 5th of September 2025, where this week myself, Tim Lincoln, and our Head of Stock Doctor Research, Kien Trinh, streamed you all things share market. How are you, Kien?
Yeah, not too bad, Tim. Reporting season's finally over and looking at some new opportunities. So it's always busy here regardless. But yeah, it's been a big reporting season and a good one.
Yeah, well done to you and the team too. Outstanding in regard to the speed of analysis, applying our methodology and getting those stocks out to our members in a really timely fashion, mate. Well done. And also the breadth of analysis. Just incredible for you and the team to have done that so efficiently. Yep, congratulations again. I'm sure our members have really embraced the benefits of everything that you've delivered. Just before we get started, Kien, just a reminder to all of our members who are tuning in today that all of the information that we share is all of a general nature and shouldn't be construed as personal advice. And all of the data, the performance metrics, etc., all historical and shouldn't be relied upon as a guide for future performance. Well, Kien, August was another really strong month for investors in the market, with the All Ords up some 3.2%. Taking the year-to-date gain to almost 15% for the market. So really, really strong bull environment, of course. But the real story was in our star stock portfolios. Star growth stocks surged 7.7% for August and are now up some 25% for the full rolling year to date. The key drivers were the gold producers at the moment, really catching up on the gold price. They were laggards there for a while, but now really catching up. And the sharp rally in gold stocks like Genesis Minerals, Ora Banda, and Volt, and technology names like Code and Infomedia, supported by solid results and a declining interest rate environment. Also, Kien, income investors haven't been left behind either. Star income stocks gained 5.4% in August, supported by sectors like retail, property trusts, and utilities. All interest rate sensitive areas that typically benefit when bond yields fall. Importantly, these stocks have all provided a 6% yield to date, which is fantastic, compared to just 3.9% from the broader market, providing investors with a really valuable source of income there. But turning to reporting season, Kien, what were some of the key themes that really stood out to you and the team?
Well, Tim, I think over the reporting season, what we saw was that the earnings trend across the market was broadly flat. Yes, a lot of companies actually met expectations, and also forward guidance was quite cautious, but yet we saw prices, as you mentioned, prices actually push to record highs, and that was fueled by optimism around those future rate cuts, Tim. And also there's been abundant of liquidity in the marketplace, especially with all that passive investing and all those funds coming through. And this has also created that divergence, as you can see on the chart, between earnings in black and the market in blue. And what's also striking is that those with weaker financial health, Tim, rallied quite strongly as well, making the market quite vulnerable later on to significant volatility down the track if macroeconomic risks start to increase.
Yeah, that's true. There's always risks lingering out there, Kien, and it's a crazy old world. And there's a lot going on geopolitically as well, still, isn't there? So it's incredible to see the markets continuing to rally so strongly. But I think, as you said, the influence of that passive flow is still really propping things up. But therefore, there's an element of speculation that is quite rife at the moment. And it appears that we are in an environment where the rising tide is lifting all boats. Hence the importance of risk management, ensuring you offload any financially weak businesses after you have confirmed its health, because of the good times cannot last forever, of course, especially in weak stocks. It's simply not sustainable. So, Kien, are there any other themes that you're picking up on also?
Yeah, the other thing we noticed, Tim, and you mentioned this, especially with those star income stocks, was that consumer proved more resilient. That consumer environment that proved more resilient than feared. You know, you had rate cuts, easing inflation, tax relief, all boosted household spending, with strength across those essentials and discretionary goods. Retailers from electronics to furniture, they surprise on the upside.
Yeah, so many of our retail stocks have done especially well. And some of those stocks include ARB Corporation, Super Retail, Lovisa, back in our universe, of course, and Universal Store Holdings, now in as a star income stock also. But I also noticed that there were strong cost disciplines within numerous companies maintaining their profit margins under Golden Rule 2, Kien.
Yeah, surprisingly, profit margins held pretty well, Tim, and that was because a lot of companies they doubled down on productivity and capital discipline. We saw record buybacks, tighter cost control, and the growing use of AI and digital tools, Tim, to improve productivity and efficiency. And while these initiatives are supporting returns and margins, the revenue growth was quite tepid. And although this is effective in the short term, it's not sustainable. So investors really need to focus on the stocks and businesses that have strong market positions and pricing power.
Yeah, absolutely, Kien. Competitive advantage, an economic moat, really, really important. And speaking of competitive advantages and the importance of, let's start with mining services software business RPMGlobal, Kien. It's been a long journey since its 2008 listing, but under CEO Richard Matthews, the company transformed into a mining software leader. Its resource planning and simulation tools are now used by major miners like BHP, Rio, and Glencore. But the recent divestment of its advisory business has led to a dilution in its return on equity, Kien, and net profit margins also under Golden Rule 2.
Yeah, Tim, but this is purely the result of the extra funds increasing and it increased the equity base from the sale of its advisory business, Tim. So that wasn't really a concern. But with that said, though, the attention now culminated to Caterpillar's 1.1 billion takeover proposal for the company at $5 per share. And this values the company at around 15 times recurring revenue, which is quite reasonable, but remains subject to due diligence. So there's no guarantee just yet.
There have been quite a few star stocks taken over in the last few months, Kien, which is wonderful for our members to see those spikes in share price of these high quality businesses and obviously contribute positively to portfolios as well. So really nice little bonuses there for members and all of us who invest in stocks that are those takeover targets. Turning to Lovisa, the jewelry retailer continues its impressive global rollout, Kien. FY25 saw 14% revenue growth with 162 new stores opened across North America and Europe. So global expansion at a great rate of knots. While sales momentum into FY26 has been really strong, up 28% in the first 8 weeks alone. This should translate into further double-digit growth in FY26, Kien.
Yeah, certainly defying this global trend of weaker consumer spending, Tim. But very few companies can generate a return on equity above 100%. And no doubt this is a company that leads in that area. The question now is whether management can translate the rapid store growth into sustaining its net profit margins, Tim, at around 11%.
Yeah, excellent. And finally, Ken, let's have a bit of a look at AUB Group, ticker code AUB. Kien, you recently reinstated it as a star income stock, and for good reason. The diversified insurance broker delivered strong recurring earnings through broking, underwriting, and SME platforms. The Tysers acquisition in the UK has significantly expanded scale, and the Tysers acquisition was major, and we erred on the side of caution, hence why we removed them a little while ago from our star income stock universe. But that's really now the integration of Tysers into the businesses adding enormous value, hence the expanded scale, with premiums more than tripling for Tysers and the overall group in FY25.
Yeah, certainly the acquisition, the synergies around that have started to come through, Tim. And
Yeah.
AUB, they offer income investors both the stability of earnings and also providing that growth avenue as well. The financial year 25 dividend was lifted by about 8% to 91 cents per share. And that equates to a gross dividend yield of around 4.1%. And although this seems quite modest, though, there is growth here because the payout ratio, Tim, is only around 53%. So they are preserving some of that capital for growth. with earnings momentum now suggesting and supporting network optimization. There's also some bolt-on acquisitions also expected and resilient fee income. AUB does present a sustainable yield story with that growth potential as well.
And now to under the microscope, Kien. And this week we're having a look at an old favourite of ours, both a star growth stock and star income stock. That's the conglomerate and the owner of the Bunnings network of stores, Wesfarmers. A rare mix of scale, quality, and diversification across retail, chemicals, fertilizers, lithium, and health for this diversified group. Despite a tougher retail backdrop and rising theft rates, group earnings rose 10.4%, translating to net margins of 6.2%, Kien, and return on equity at a standout 32%. So, Kien, how did a company of this size actually increase margins so strongly?
Yeah, it was quite incredible, Tim, especially with the increasing theft rates that's going on, especially across Victoria.
Yeah.
But there were two engines that did the heavy lifting. First, Bunnings, they extended into their higher velocity categories. That's cleaning, pet care, energy, and also automotive. And that also provided that avenue for growth. The other one is they refreshed their tool shop formats. That drove increasing foot traffic as well. And of course, you had Kmart. They were able to sustain their sales via their own brand, Anko. And that mix also, plus tight cost control and disciplined inventory levels, offset some of that shrinkage pressures and high operating costs that was quite prevalent across the sector.
Yeah, and also noticed, Ken, a nice lift in dividends to 206 cents for FY25, fully covered by free cash flow per share of 302 cents per share at an 81% payout ratio as well. So really sustainable yield metrics there. This also underpinned a proposed $1.50 special dividend as well. The market is forecasting dividends to rise further to 218 cents per share in FY26, but the lithium segment continues to weigh on the business a little bit.
Yeah, that's right, Tim. I mean, they did invest in lithium not too long ago, and we saw losses. They were widening as the integrated Mount Holland Kiwanda build out and also softer commodity pricing weighed on that division. But management does remain constructive on the long-term demand. But in financial year 26, the segment is more likely to dilute their earnings than enhance them, Tim.
Yeah, and despite all of this, Ken, it's still a relative small part of the business, but will contribute towards growth when lithium prices recover. Apart from this, what's expected to really drive growth for Wesfarmers, the group, moving forward, Kien?
Firstly, Tim, I think they are doing quite a few things, especially around Bunnings. They're expanding and also formatting just the store layout there, and with management also noting that sales momentum has accelerated into financial year 26 as well. Secondly, Kmart scale and also their sourcing advantage through Anko should keep volumes quite resilient there. And third, the business has that financial capacity and strength, Tim, to fund more capital expenditure. Also, there might be some selective M&A activity along the way, and that's not going to put any pressure on their balance sheet because they've got such a strong balance sheet there.
Yeah, we're talking about moats and competitive advantages before, and when you got such a strong brand equity across such a powerful brand like Bunnings, it's certainly contributes to their overall enduring strength, doesn't it? So very impressive. But Kien, the share price has rallied strongly. We can't deny that. And the stock appears to be trading at a slight premium to fair value. So tactically, what should investors be thinking of doing right now?
Tim, there's always that argument that a premium is justified for such good quality businesses such as Wesfarmers. And, the thing is, especially when they've been able to ride through that challenging consumer spending environment. However, those who are overweight, they should consider taking profits just to manage that portfolio risk, especially during a period now we're entering where, volatility could pick up and we've had such a good reporting season.
Yeah, and we love to see portfolios consist of around 15 stocks at least to offer diversification. And personally, I look at an overweight position of a stock exceeding around 10% position size. So there's some rough rules of thumb for our members to use when potentially trimming some excess from their individual holdings, like potentially a Wesfarmers. And with reporting season now behind us, Kien, question of the week really starts to focus on how to manage portfolios with an increasing number of star stocks in the overall universe. So with so much choice, how do our members potentially construct or optimize a portfolio from the star stock universe, Kien?
Yeah, there's so many star stocks now, Tim.
Yeah.
But the first step is to determine your overall investment objective and also your tolerance to risk. Given that equities are quite volatile, but it is quite a rewarding asset class in the long term, your allocation to equities will also depend on your stage of life and your net worth as well. So once you understand this, you will need to identify whether you are a growth or income investor.
Exactly. To access the feature, click on the Portfolio Constructor button within the Portfolio Manager itself. Then just have to simply follow the instructions in the pop-up window. And if you're a growth or income-focused investor, conservative or aggressive, all of those options are there. You can also set your holdings and capital amount limits as well. Simple, and as I said before, a super powerful way to, construct a portfolio aligned to your objectives.
That's right, Tim. You then need to indicate whether you are sensitive to share price falls as well. For example, if you are sensitive to downside volatility, the Stock Doctor tool will only recommend the stocks which have not triggered an exit on the SD30 TSR or the SD Max, depending on your profile.
Yeah, great stuff, Kien. Excellent. So it's really covering for all types of investors, whether you're long only, like sort of we are, or if you're sensitive to volatility, all the tools are there. Also recommend that perhaps you have a look at our strategies white paper and video, which also articulates all of the strategies behind this as well. The portfolio constructor will provide you with a list of star stocks ultimately, and that's where investor judgment comes in. Reviewing each stock and drilling into each one is critical. Checking the golden rules, reading the analyst commentary, and removing any you're not comfortable with that may not align to your ethical or moral considerations either. And from there, you can save your list to a watch list or print it out or trade directly if you've linked your portfolio to a Bell Direct account.
Yeah, that's right, Tim. And later on down the track, if you need more ideas and you've already constructed this portfolio, the portfolio optimizer can then suggest stocks to improve your portfolio's balance between risk and return. Or you can simply mirror the star growth or star income stocks directly as well.
Yeah, it's pretty simple to do that. So with the star stocks and star income stocks having such wonderful returns over the long term, if you choose to just take that really simple approach and just mirror our star stock full universe approach, sure, you're going to end up with a lot more stocks in your portfolio, but that will work as well. But if you think you've got the ability to narrow down the group of stocks to a 15 to 25 stock portfolio using things like earnings revisions as the priority weighting towards certain stocks, then by all means, that's another way to go and should produce wonderful long-term outcomes too. And of course, Kien, you and the team and our members' relationship managers are always there to help at the same time as well to use the tools or navigate how members can get the best out of tools like the optimizer and constructor. Thanks a lot, Kien, for sitting down today. Been a wonderful chat. And well done on an incredibly successful reporting season for not only our members, but also on the group of stocks that you and the team have been able to identify.
Yeah, it's been a great reporting season, Tim, and thanks to you and for all your support and the support of our members. And of course, don't forget to attend our Lincoln Live on Monday if you have any questions from the reporting season, because over the next couple of weeks, we'll be releasing new opportunities within our star stock universe. So watch out for that.
And also, I'll drop a quick little opportunity. If anyone is really considering strongly joining our Platinum membership, we do have a few seats available in Brisbane on Tuesday lunch, Melbourne on next Thursday lunch, and then Sydney a couple of weeks after that. If you're interested, call the office and express your interest in attending those exclusive Platinum lunches. But really they are available if you're seriously considering coming on as a platinum member. So the opportunity's there, a couple of seats available, but getting quick because there are only a couple of seats left. All right, Kien, wonderful sitting down again. Thanks a lot. Hope everyone enjoyed it. Have a happy, healthy, and prosperous week.